And General Electric didn't help matters any. It was the worst performing stock on the Dow Index, falling more than 2.5% after reporting disappointing quarterly results. And as Morgan Brennan reports, it also announced another surprise to shareholders.
Call it another kitchen sink quarter. General Electric missed expectations and disclosed an SEC investigation tied to last week's announcement of GE Capital's $15 billion insurance charge. GE saying the investigation is still very early and not unexpected given the magnitude of that charge. Still, it spooked Wall Street. Even analysts with buy ratings on the stock found little to be optimistic about right now.
Not a thing, except that one thing, that 2018 is going to be an awful year. In terms of what John Flannery walked into, remember he's a GE lifer. This is the biggest mess since Ed Breen had to walk into Tyco International over 15 years ago and save the ticker symbol.
Since taking the helm last summer, CEO and Chairman John Flannery has been embarking on a massive turnaround. Already, he's cut more than $1.5 billion of costs with plans to cut more this year. He has said repeatedly that everything is on the table, including a possible breakup. But investors looking for more clarity on that long-term strategy didn't get it today.
We have a team dedicated to considering all the details and looking at the options that will deliver the best value for our shareholders and the most attractive jobs for our employees. The truly enduring strength of GE lies in our people. There will be a GE in the future, but it will look different than it does today.
Other key takeaways: industrial cash flow for the quarter and the year were better than expected, and GE did reaffirm its 2018 earnings and free cash flow guidance. Welcome news for analysts who were bracing for revision lower. The healthcare and aviation segments grew, and Baker Hughes, the oilfield services firm in which GE is majority stakeholder, posted better than expected results. But once again, power proved to be a huge issue. Profits plunged almost 90% last quarter, and the company is now warning it may get even worse in 2018.
When he first had his restructuring announcement in November, he said we're going to sell off $20 billion in assets. And now here it seems like maybe power is on the table. It's hard to value a company when you don't know what direction it's going to go in.
And that uncertainty sent shares lower again today. For Nightly Business Report, I'm Morgan Brennan at the New York Stock Exchange.